Hi, everyone. I'm Marco Giometti. I'm a PhD job market candidate in finance at the Wharton School of the University of Pennsylvania. And I would like to thank you for your interest in our paper on bank specialization and the design of loan contracts. In this paper, we provide novel evidence on the U.S. syndicated loan market by showing that, first, banks specialize in lending towards specific industries. Second, specialized banks provide credit to these industries with lower restrictions, that is, looser covenants, and a lower interest rate. We interpret these findings as evidence that specialized banks have an advantage in monitoring certain industries relative to other banks and other industries. We believe this is relevant for at least three reasons. First, we document a novel dimension of bank specialization in lending, complementing existing evidence in contrast with standard theories of financial intermediation that would predict portfolio diversification. Second, our paper has implications for our understanding of systemic risk. Our policy insight is that a higher sectoral concentration might not be necessarily concerning if superior bank monitoring abilities indeed accompany it. Third, recent evidence on specialization documents that firms cannot easily substitute credit across specialized and non-specialized lenders. By showing that firms can obtain better contract terms from specialized banks, we suggest a possible interpretation for this fact. Let me tell you more about our empirical approach. We characterize bank specialization in two ways. First, we employ a measure of dispersion in bank loan portfolio shares across industries, and we show that the portfolio of the average bank is more concentrated than the market. Second, we present more direct evidence of specialization in lending to specific industries. In particular, we show that banks generally have an abnormally large loan portfolio share in at least one sector relative to other banks. Thus, we say that these banks specialize in lending in that industry. In our empirical investigation, we rely on the second measure. The goal is to estimate the causal effect of bank specialization on loan contract terms, such as covenant strictness and the interest rate spread. To be precise, when I say covenant strictness, I mean the ex-ante probability of violating a covenant. Intuitively, covenants are stricter when this probability is higher. In our empirical strategy, we employ a within-bank approach, comparing contract terms between loans made to different industries by the same bank at the same time. In our baseline results, specialized banks provide credit with covenants looser by 8 percentage points, amounting to 20% of the average covenant strictness in our sample. The theoretical literature on financial contracting offers a potential explanation for this finding. In theory, covenant strictness should reflect the degree of asymmetric information between borrowers and lenders. Thus, we interpret our results as evidence that lenders specialized in one industry have an information advantage in monitoring borrowers in that industry. In line with this interpretation, looser covenants are not compensated by a higher interest rate, which appear to be lower as well. To further validate this interpretation, we perform an additional test based on the variation provided by defaults on bank loan portfolios. Why? The literature suggests that these defaults represent shocks to the lender's assessment of their own screening ability. Therefore, we posit that in response to defaults in their loan portfolios, specialized lenders should tighten contract terms more, but only when such defaults occur in the industry of specialization. This is exactly what we find. Importantly, we show that this is not simply a byproduct of a higher concentration risk implied by the higher industry exposure of specialized banks. To conclude, in this paper, we provide novel evidence of bank specialization in the U.S. syndicated loan market. This evidence is consistent with a monitoring advantage explanation of specialization in lending and suggests that firms might not be able to substitute credit across banks because of the specific nature of contract terms defined and offered by specialized and non-specialized banks. Thank you again for your interest in our paper.